After studying this module, we shall be able to first know how to compute sale price and sale volume variance, learn how various variances are disposed of, and third, understand the managerial use of variances. Now we start our discussion with sales variances. Sale is the main source of revenue, and variance in sales revenue can either be caused by changes in price or changes in volume. We have two methods to calculate sales variance, namely first turnover or value method and second margin or profit method. We start with the first, that is turnover method. Here the variances are calculated with the help of formula, that is sales price variance is equal to within bracket actual price minus budgeted price close the bracket multiplied by actual quantity. Again, sales volume variance is equal to actual quantity minus budgeted quantity within bracket multiplied by standard price. And then finally we have total sales revenue variance is equal to actual revenue minus budgeted revenue. This box layout can be used for the revenue variances where standard information is replaced with budgeted information. The revenue variances can be adverse or favorable depending on whether the expected selling price and volume of sales were achieved. The second method is margin method variances. Here the variances are calculated with the help of formula, that is sales margin price variance is equal to actual profit per unit minus standard profit per unit within bracket multiplied by actual quantity. Again, sales margin volume variance is equal to actual quantity minus budgeted quantity within bracket multiplied by standard profit per unit. That gives us total sales margin variance is equal to actual revenue minus budgeted revenue. Keep in mind that revenue will operate in the directly opposite way to cost. If the actual sales revenue is less than that of budgeted for, the variance is adverse. And if the actual sales revenue is more than that budgeted for, the variance is favorable. Reasons for the variances. Sales price variances are caused by change in price, change in demand, competitors' prices, prices of similar products, etc. Sales volume variances are caused by poor sales force, low levels of production in stock, cancelled orders, high sales returns, etc. Now we explain this thing with the help of an example that shows calculation of sales revenue variance. Now we explain the concept with the help of a problem. This problem shows the calculation of sales revenue variance. We have one problem to compute sales variance with regard to the following figures. Now we come to the solution. First, as per turnover method, sales price variance is equal to within bracket actual price minus budgeted price close the bracket multiplied by actual quantity, that is 5.5 minus 5 within bracket multiplied by 3200 plus within bracket 2.5 minus 3 close the bracket multiplied by 1800 plus 4.5 minus 4 within bracket multiplied by 4400 plus 7 minus 8 within bracket multiplied by 1600. This gives us 1300 within bracket F, close the bracket. Then we have sales volume variance. This is equal to actual quantity minus budgeted quantity multiplied by standard price. So we have 3200 minus 3000 within bracket multiplied by 5 plus 1800 minus 2000 multiplied by 3 plus 4400 minus 4000 within bracket multiplied by 4 plus 1600 minus 1000 within bracket multiplied by 8. This equals to 6800. Then we have total sales revenue variance. This equals to actual revenue minus budgeted revenue. This is equals to 3200 multiplied by 5.5 plus 1800 multiplied by 2.5 plus 4400 multiplied by 4.5 plus 1600 multiplied by 7. This gives us 8100. Now as per margin method, sales margin price variance is equal to actual profit per unit minus standard profit per unit multiplied by actual quantity. So this equals to 2.5 minus 2 within bracket multiplied by 3200 plus 1.5 minus 2 within bracket multiplied by 1800 plus 2.5 minus 2 within bracket multiplied by 4400 plus 2 minus 3 within bracket multiplied by 1600. This equals to 1300. Then we have sales margin volume variance. This equals to actual quantity minus budgeted quantity multiplied by standard profit per unit. This equals to 3200 minus 3000 multiplied by 2 plus 1800 minus 2000 within bracket multiplied by 2 plus 4400 minus 4000 within bracket multiplied by 2 plus 1600 minus 1000 within bracket multiplied by 3. This equals to 2600. Then we have total sales margin variance, that is actual revenue minus budgeted revenue. So this is 3200 multiplied by 2.5 plus 1800 multiplied by 1.5 plus 4400 multiplied by 2.5 plus 1600 multiplied by 2 minus 3000 multiplied by 2 plus 2000 multiplied by 2 plus 4000 multiplied by 2 plus 1000 multiplied by 3. This equals to 3900. Now we start understanding the various methods of disposing variances. If standard costing method is being followed and recorded in the books of account, then need arises for making adjustments for the various variances. As standard costs are entered into books of account as cost of product, but if actual cost is different from standard cost, so it is necessary to incorporate the variances for different cost. If cost variances are favorable, then actual costs are less than the standard cost, and if cost variances are adverse, then actual costs are more than standard cost. Disposing here means the way of treating the variances, as after opening the variance account, we need to close it by transferring it to some other account. For favorable variance, we have credit balance, and for adverse variance, we have debit balance. On the other hand, when we just use standard costing like a statistical tool without recording standard cost in the books of account, then we do not need any adjustment for variances. There are different methods of disposing of the variances. The first method is transfer to profit and loss account. Under this method, all the variances are transferred to profit and loss account. Favorable variances are transferred to credit side and adverse variances to debit side of profit and loss account. The value of cost of goods sold, work in progress and closing stock is maintained at standard cost. This method follows the philosophy that all the adverse variances are because of inefficiency in the operation and favorable variances are just for this time due to some extraordinary conditions and not likely to continue in future. This method follows the premise that standard cost represents true value of cost of goods sold and inventories. The second method is allocation of variances to cost of goods sold and inventories. Under this method, variances are allocated to cost of goods sold and inventories on some justifiable manner. This method follows the premise that standard cost is just a control technique and does not present the true value of inventories and cost of goods sold. So, there is a need to adjust the value of cost of goods sold and inventories in order to reflect true value. If we have favorable variance, then the cost of goods sold and inventories would decrease and profit would be affected depending on the magnitude of adjustment for cost of goods sold, and inventories on the other hand with adverse variance, cost of goods sold and inventories would increase, which would in turn affect profit, but whether it would increase or decrease depends upon the magnitude of adjustment for both. The third method is combination of both the above mentioned methods. This method is a combination of both the methods mentioned above. In this method, we classify variances into controllable and uncontrollable. Now, for different category of variance, we use different methods of disposal of variance. For controllable variance, we use the method of transferring to profit and loss account, as these variances are due to the inefficiency and can be controlled by the management in future. So, in order to keep the cost as per standard cost, this method of disposal is best for controllable variance. On the other hand, for uncontrollable variances, we use the method of allocation to cost of goods sold and inventories, as these variances are not due to inefficiency but because of wrong calculation of standard cost or due to changes which are not in the hands of the operating firm. Then we have managerial uses of variance analysis. The first use of variance analysis is that it involves breaking down the total variance to explain how much of it is caused by the usage of resources differing from the standard, how much is caused by cost of resources differing from the standard. Together, variances can help to reconcile the total cost difference by comparing actual and standard cost. The main purpose of variance is to provide reasons for off-standard performance. In this way, management can improve operations, correct errors, and deploy resources more effectively to reduce cost. The second point is the analysis of variances facilitates action through management by exception. Here, managers concentrate on business areas that are performing below or above expectations. Managers can largely ignore those that appear to be conforming to expectation. The third, the setting of standards and revision and monitoring encourages reappraisal of methods, materials and techniques. This leads to cost reductions and process improvement. The next advantage is a properly developed and understood standard costing system with full participation and involvement creates a positive attitude towards cost control throughout the organization. The last advantage is modern technology and reporting software has allowed for variance analysis to be undertaken automatically without the need for complex manual calculations. Microsoft Excel Work Essentials is a commonly used tool to undertake variance analysis. This has made the task of managers easier and they can do analysis of variances very efficiently. Now we make a summary of the entire concept. In this module, we have studied about sale variances and different methods to calculate sale variance. Sales variance, as explained, refers to the variance in the sales revenue due to the changes in sales price or sales volume from a predetermined value. To calculate sales variance, we have two methods, namely turnover method, where we consider selling price for calculation of variance, and margin or profit method, where we use margin of a particular product to calculate sales variance. We can use many methods to dispose variances. Widely used methods are transfer to profit and loss account and charging of variance to cost of production.